My guest today is Don Mango. Don is the principal of Insure Solutions and an adjunct lecturer at Columbia University's School of Actuarial Science. Don has been an important thinker in risk management, ERM, capital modeling, and I'd say the theory of how to manage insurance companies generally. I think of Don as walking, perhaps better than anyone, the line between academic rigor and down-in-the-weeds compromise. In that sense, he epitomizes what it means to me to be an actuary. Don, welcome to the show.
Thank you, David. It's a pleasure.
So you started your career at ISO, as I could see online, and then worked in what seems to me to be a reasonably traditional actuarial role at Crum & Forster. Then suddenly you threw this lightning bolt at the industry with a paper on game theory and property cat risk loads. How old were you when you did this, and how did all that come about?
Yeah, Crum was really good to me. When I joined, it was wow. I mean, my wife and I actually met at ISO. She's an actuary as well. She hasn't worked as an actuary in quite a while. She likes to say she's a recovered actuary. She's manages the home office, if you will. But Crum, when we joined, had personal, commercial, had Constitution Re, just was a really large conglomerate. So, and I went through a lot of kind of painful transition while I was there, but I was able to work in personal and commercial pricing and reserving. They had agency-owned captives. They had catastrophe modeling. I actually was a cat analyst for a little while there. They had ceded re. So, really was the full kind of breadth. And we both had fortunate to work for some really great managers, and we all kind of agreed after that sort of run that, I'm, whether I'm a creative person or I have ADD or whatever, I don't know. But, once you've kind of done the circuit, your choice is whether you kind of want to manage people doing those things, or do you want to try your hand at some other things. So we kind of agreed for me to look around, and I went to Center Re at the time, and the game theory paper really was a natural extension of sort of the way it turns out I have learned that I operate. I'm more of an intuitive leaper. I was never good at proofs. If you remember geometry or whatever, that wasn't me. I didn't major in math. I majored in mechanical engineering at university because, and I actually believe the actuarial profession is much more of an engineering profession than a hard science. Engineers, I always think back to the movie Apollo 13, where the great scene where Ed Harris throws down the materials that are in the capsule and says, you got to make a CO2 converter out of this. Right?
Awesome.
I mean, that's to me, actuarial work is, here's the claims, right? Here's the price monitoring data we have. Here are the claims, right? Now price this. It's scientists are more, and my father's a research scientist. He was a chemist, and, scientists design experiments. They run beautiful, pristine experiments. They collect all the data. They have loads of data. It's very clean and orderly and neat, and they get to apply very elegant statistics. I think actuarial, especially P&C, is much more applying moderately sophisticated statistics to very poor data, and that's where the experience element comes in. So when I was in that catastrophe role at Crum, and also working with ceded re, and was working on, in fact, capital allocation work for the catastrophe. We had a great guy named Jim Zakowski who ran CAT. He was a very technical underwriter, and he was asking me things about, what's the risk adjusted return on the CAT business in the different states, and which agents are we making the most money off of, and so on. And so as I was decomposing the CAT data, I started running into these problems, which was like, the stuff wasn't adding up and so on, right? Depending on the order in which you did it, you get a different answer. And that was just me. Again, I'm more of this intuitive kind of flailer that sort of, I'm decent, good skills in Excel or SAS or whatever. And so I would just sort of maybe I was a data scientist in the early going without realizing it, but I would sort of, mince and dice and chop it up all different ways, and kind of kept looking. And then, was fortunate again because we had Guy Carpenter, ironically back then, as our broker. And back then there was not much of an internet, if you will. So Guy Carpenter had a great library, and I started looking around in Aston bulletins. So that's the International Actuarial Society journals. And I found this paper by this Belgian actuary named Jean Lemaire. And I remember it's, still to this day, it was on the application of game theory. I got the title for my paper as a, tribute to him, because he was talking about it for, expense loading or whatever. It was actuarial in nature, but he was really the pioneer that introduced me to this notion of sort of, cohorts and factions and order dependence and all this stuff in the game theory space. And really what was funny about it was that it was game theory that kind of led me down the path. But, what it really uncovered was not so much game theory, but more of kind of like a methodological problem, which then became part of the research into what was called coherent risk measures. Really, I was sort of, again, stumbling around on stuff that later people like Paul Embrecht's, formalized more mathematically around, risk metrics that can be decomposed in an additive manner and so on. And really the bottom line was that if you're using a PML or, value at risk measure, a percentile risk measure, there's order dependence, and there's no way around it. It's the same with standard deviation, so what are you going to do to deal with this order dependence? And that was sort of the basis of the paper.
And how did that affect your life? I mean, not everybody tries to publish a paper, right? And fewer probably succeed. So it's a heck of an achievement, right? And how did that affect your life?
Oh, I mean, met some fabulous friends and research partners. Got to actually go to the CARE seminar and present in Bermuda. And met Jim Stannard. I mean, it really, and met Gary Venner and John Major and Rodney Krebs at Carpenter. I got to present it at individual companies. Then when it was accepted to proceedings, got to present it at the annual meeting. And I mean, really, it started a lot of the name recognition that I've enjoyed, the blessings of since then. So yeah, I mean, yeah, you're right. It's sort of, and look, nobody was more surprised than me. So, yeah, it was, but, I just was sort of, I think it gave me some confidence. The biggest change probably was it gave me confidence to, kind of continue, chasing the rabbits that I saw. And again, maybe that's just part of my hardwired nature, is I tend to gravitate towards, stuff that doesn't seem like it's fundamentally sound, if you will. I mean, there's some people that are okay with things being, close to, they could have figured workarounds, if you will. And I'm not opposed to workarounds and so on, but like I said, I get these intuitive sort of, compulsions around, like, gee, that just doesn't seem right, and I think there might be a simpler answer to it. I remember a good friend in college who was a computer science major that said that you're in pursuit of elegance, and he was talking about algorithms there for computer science people, and I think that's a wonderful summary for what I try to do. I'm not looking for anything ornate or complex. In fact, I kind of, I tend to work the problems until I start seeing real fundamental simplification and harmonization with other things. That's something I do when I do research. Like I said, the reading the Jean Lemaire and then some other papers on game theory. that's great stuff. I'm a big believer that a lot of the problems we have in insurance and actuarial there is help available in other things. I very often draw upon engineering and physics analogies, and I know other actuaries who studied engineering, physics, whatnot. I think there's just a lot of valuable parallels, and that's one thing I try to encourage actuaries to do. Is don't be afraid to look sideways as opposed to constantly. I think we have a strong bias to being sort of like, let's just go back to our actuarial, papers and the body of knowledge because it's all there. And look, we have a very valuable professional body of knowledge, no doubt. I'm not discounting that, but again, it's a lot of the more valuable contributions I made. I drew from stuff that was very far afield from standard actuarial.
Yeah. It's still, there's this funny thing about in the actuarial field because we're working for organizations which use. I mean, your that first paper was definitely what you were working on in your day job, right? And you could imagine that was something that your organization would have liked to use themselves, and not necessarily something you just give away, right? I mean, if you develop a new product, think of Google, right? Just sort of and they do that, which is interesting in and of itself, I suppose. But it seems to me the compulsion is, or if you can call it that, I don't know what does make you want to do something like that, and why were you allowed to?
Yeah, amazing that you really hit it. So Centaury was an example of a company. There were a lot of them over that tenure that was trying to hybridize into financial products, tradable risk more, and they had a group of quants, like real quants, what you would call financial engineers today, like real Wall Street people, rocket scientists, actual physicists. One guy, Sergei Esipov, it was a Russian physicist who published papers and whatever. And that was one of the aspects that they could not get over about actuarial. Because they said, you guys are crazy. You go to these conferences, because I think, I worked on a paper with Sergei and helped him. And he wrote a brilliant piece on, and then he could not believe that you go to a conference and just present it, and that Centaury was like, great, with a thumbs up, because from their world and the hedge fund world, that is like, what are you, nuts? That's
yeah.
The whole point of your research is to develop an edge, right? And then do it. So I can't, it's funny, I've been talking with a lot of people outside of our business over the last few years, they trying to explain the actuarial profession, they give you just some funny looks. And I don't mean like the technical details. I mean just the elements like, how much it almost is like a guild, if you will, right? That the profession sort of spans the employers, right? Mm-hmm. And that there's this fraternity, brother and sisterhood of idea sharing, and that there's this virtual, the CIS is like a virtual university and all this. It's just, so yeah, this I can only describe it as culture in that, when you join companies and start working in the profession, and then you get your first designation and you go to the meetings, and it's just, you see it, right? You see it firsthand. People up there going, no, they're not sharing prices, right? We're not colluding, right? It's a fine line. It's sort of like acknowledging, I think back to that sort of idea that, you're all dealing with very tough data and unique situations. I think there's that it's about sharing things that have worked for me. And I think there's very little risk of sort of this idea that, we're not, I'm giving away something that's going to, give you an advantage or disadvantage me or whatever. And I don't know if this has to do with the fact that, the quants are all dealing with Reuters and Bloomberg data. Like all the data is there. Everybody can see it. It's all the same for everybody. For us, it's the exact opposite. It's almost like there's a theoretical possible universe of insurance data, and we're all getting a small portion of it, right? So it's almost like we're all partially blind, and then we're, the old which part of the elephant are we touching, right? We're all sharing things about, well, gee, based on, what we saw, you might want to try this, you might want to try that, whatever, all without, like I said, walking that fine line of not colluding. But yeah, no, it's a fascinating thing, and I don't, you could not recreate this profession today if it didn't exist. I don't think. It's just an amazing kind of, accident of evolution or something.
I really like your point about the culture of the actual profession. I started out as a broker, as a reinsurance broker, and moved over to the actuarial side of our company. Like in my late 20s, basically. Started taking the exams, and when I first started going to those conferences, just as you spoke, get my first designation, and you just sort of have this feeling of, it's almost like a feeling of relief. I'm not sure what it is, where it's like, here, we're all in this together, guys, and we all got through that exam process. Holy cow! Then we'll talk about that for a little while and whine about that, and then really just sort of talk about everything we're working on, and there is a feeling of, the equivalent is something like a family, I guess. I'm not sure what it is, but that feeling is definitely there, and I love the culture of that profession, which really surprised me. Actually, you think about it as being the technical side of insurance, but when you get there, it is once again about relationships, and I think that to me is an important part of why things get shared, and techniques, because I think that there is a huge information problem, is that we don't really know what can work and what is right. You're always terrified when you're taking on risk about whether you're right or not, and also I think that there needs to be a certain coordination, which happens in the marketplace with huge information lags, and in the hedge fund world, they know instantly whether something works or not. For us, it's like we got to wait around for a couple of years, or maybe a long time before you know if it's real. And if everybody's not singing from the same song sheet, then you get people diverging, and then some people are gonna, could screw it up for everybody else and themselves, but they don't know that yet. So there's a huge amount of coordination which goes on in insurance, which I think is necessary, but is really weird.
Yep.
Completely
agree.
So I want to come back to your Centaury days, because you had this sort of really pumped out the papers for a little while there once you got there. Was that part of your job? Was that kind of like explicitly saying, hey, Don, you got something here. Why don't you just keep doing that? Or was this something you just sort of were able to pick up?
Yeah, that role, I was fortunate to work. I mean, general. You knew Frank Pearson or Mel Pinto, but Centaury was again one of those really unique animals that was by definition research in action oriented, because they were by definition not doing anything traditional, right? It was almost it was the beginning of non-traditional, quote unquote, right, reinsurance. So they were built on innovation. So it was right that the original idea of finite risk was completely different approach to things, right? The idea of an experience account and sort of this, it was a precursor to a lot of stuff. Now they really changed reinsurance, and I was brought into, and they had a research group recognizing again, which was kind of an interesting group. It was like a fine balance between standardization and flexibility, because you couldn't really standardize what was being done there, let's say in the actuarial side of the house. It just, every deal was different enough that it was tough to say everybody must use, this pricing model, et cetera. So we actually were the builders and keepers of what was called the Gen model, which was this generic model. And, just to date myself, when I came in, the version I inherited was written in Lotus 123, and my task was to port it to Excel.
Wow.
And at the time, this was, early days of VBA and whatnot. And so it was a real learning experience in general, just to figure out how to write, VBA equivalents of all this stuff that the thing was doing. And then nobody liked certain elements of Excel, and we had to do the documentation and training and whatever. But you think of it more like kind of an 80-20, where, everybody started from the same Gen model template, but that was covered probably 80% of the necessary functionality, but the remaining 20 was always deal specific. So, being the same, now enough about the way my squirrely mind works, I started, looking at it, and one of the profound problems that everyone there acknowledged was with capital allocation. And they were like, again, Frank Pearson, Mel Pinto, these are great thinkers in the space. And they were like, well, we know something's wrong, but what else are we going to do? Again, it's classic actuarial. It's like, you got to do these deals, right? So the classic case was, Center moved into now, and they knew this from other issues, but they were moving into credit enhancement. And the one that they used that really sort of finally broke the camel's back to me was credit enhancing the balloon payment for a jet airliner. So this is a financing of an airliner where there was one big payment due in 7 years. Let's make up number, right? Got a big payment, $100 million due in 7 years. And the question is, what's the capital allocation? Because you could actually make the argument that the risk is all sort of concentrated, the day of the payment, right? Like there's technically no risk, quote unquote, right, between now and 6 years and 364 days.
No cash flows. Yeah.
Right. There's no risk. Okay. I mean, this is really, look, like I said, this is where mentally the thing broke. And at the time I was also, starting to try to work and reach out to other people in the CAS and even the international actuarial bodies and people like Phil Heckman and what, I mean, it was just like, people were circling around the carcass, but nobody had any kind of, we were really, really struggling with it. So yeah, the whole notion of paper I really actually love that has stood the test of time, and I don't think's ever really, I think it was a precursor for a lot of other stuff, was risk load and the default rate of surplus. And that one, I got attention from banks all through the Center Re people, because when they saw the title, they were like, whoa, what are you talking about here? And I think it was, again, sort of a precursor of collateralized reinsurance and even debt finance, like sidecars or whatever. That was really all it was doing, was saying, and this was just back to me looking at this thing and saying, look at that 7-year kind of balloon payment, right? So, when under the capital allocation mindset, they were like, well, do we allocate it from time zero, or do we allocate it in the 7th year? But what point in the 7th year? Because it was a difference between the deal looking awful if you had to support 7 years of a big number, right? Where nothing, or if it was all, we pushed it all into year 7, it was like, oh, so we only really have to worry about capital for, allocating it for one time period and whatever. It just, again, looking at it in hindsight, it was like, wow, I could, the glimpses were coming to me, but I couldn't quite make sense out of it. But, that was where I first started thinking about, well, why don't we look at scenarios? And this was kind of the radical leap. The first of the radical leaps I made was this, and I think it harkens back to, if you remember, the infamous Jensen's inequality. And again, I'm not super mathematician guy, but that's the one that says, E of f of x is only equal to f of e of x if it's like a linear function. But if there's any kind of, if you will, convexity or nonlinearity to it, you can't just do an operation on the expected scenario or value. You have to take the expectation of the function over the different possibilities. And when you do that for the balloon payment one, it just cleared it up. But it required you to not allocate capital. Because then the answer was, never mind allocating capital, yes or no, and for how long, it becomes scenario one is nothing happened. And the good news, or whatever, the simplification that was available on the balloon payment was essentially they were like, look, they're either going to default or they're going to pay it. And even if there was partial payments, that was not that big a deal. They just said, look, let's just look at two outcomes, right? We make the payment, the insured makes the payment, the insured doesn't make the payment. Then it's like you got two scenarios, 95% chance, nothing happens, 5% chance we have to come up with 100 million in 7 years. And that's trivial. Then you get all these, all the simplifications start to just flow out. That's how I knew I was on to something, because I'm like, wow, that just simplifies everything. now it's like, what's the amount? Now you don't have to worry about coming up with some weird risk-based capital number or whatever. It's like, no, the amount is X, whatever, 100 million, right? We know the amount. Probabilities we're estimating. You want to discount it back, yes or no, it's up to you, but just makes life a lot easier. So, the center was, my job was so naturally research oriented that, they were supportive because I was putting it into action. That was not a esoteric paper. It was actually sort of like, I felt that we had made progress and that the industry could benefit. Like you had said before, if we don't do this, are people going to be, missed? Because there were other companies in the space also kind of doing stuff. And we felt that it was, valuable to all parties to, everybody be pricing this in a more accurate manner. So, yeah, but they look, credit to them. They were very supportive of it.
And some of the papers, though, and I went through them, don't seem like they're kind of what I call normal papers. Breakthrough papers. You have some kind of papers that it almost feels like it's a funny kind of thing to say about academic papers over the course of several years. It's almost like a stream of consciousness, or it's sort of like Don Mango's journey. Where you have there's one on there where you basically write a paper which is, the result is wrong, and because you say this result's wrong, but that's because the normal copula sucks, and don't use it, and that's your paper. And I was like, wow, okay. And there's another one which I really like too, which I like this because I see this as, my first introduction to you was I think I saw you speak somewhere, and you were frustrated with how you felt that some of the, call it quasi-academic views didn't really mesh with how things really work on the ground, and sort of this sort of pragmatic kind of perspective on things. And this paper is more or less how to present DFA results to a board of directors. And then you just tell a story where, and then you say, well, one guy found an error, and we had to go back, we had to check it again, and we went back again, and they found another error, and we had to go back. I was like, oh my God, this is my life as I'm reading it. So why so much kind of, I don't know, what possesses you to write papers like that, which are really kind of, I don't know, it's almost like a narrative of sort of your journey of how you're learning about how to do this stuff.
Yeah, no, it's great points. I think that once I kind of, again, got some confidence and the reception, it became a feedback loop. The reception was really positive, and I've been, also blessed. Look, I know, that people rate public speaking, like the next to fear of death or whatever, right? But for whatever reason, it comes naturally to me, and I try to make the stuff funny and accessible as much as possible. So I think it was sort of like building on itself. So and I'm remembering another one, the low discrepancy points one, that was 100% research we were doing at Center for that Excel conversion, and was based on the like quant firms we had access to via the quant people that were on staff, and I just felt like it was another one of like, wow, this is really valuable potentially, and I had certainly never heard of it, and I couldn't imagine that an actuary in a more traditional role or company would ever have gotten access to it. So I was trying to provide, like, hey, everybody benefit, or as many people as possible benefit from this good fortune that I've had. But yeah, I mean
that one was surprising because that was
Yeah.
about random number generation, which jumped out at me too.
Yeah.
Really kind of a real in the weeds of here's how DFA should be done in terms of generating numbers.
Yep.
That's what you're talking about, right?
Yeah. Yep. Oh yeah, that was in the weeds. But then the dependence model one with where we're sort of like, we got a problem. 100%. Remember it to this day. That's what Jim Sander, who's a great American Re guy, actuary there. I was fortunate to work for Dave Spiegler, who was a real visionary chief actuary, and again put me in a research role. Said, hey, so start solving some of these problems, and there's another one just like the game theory one. That's that's like real work product. I mean, we were like, okay, because we had you're talking about hundreds of deals being priced at American Re, $4 billion portfolio. This was a big deal. And this was a big debate among the actuaries and underwriters. And like, okay, because, Spiegler pushed the envelope and said, we're going to start using, some of this DFA evolution, because up to that point, American Re wasn't really using it in pricing. So Spiegler was like, let's start trying to use it in pricing. So, me and Sander and a few others, Dave Clark, were like, okay, let's try to use this. And it was like we slammed into a brick wall, like head on. We were like, wait a minute. So this was this is an example, Sander was really good with, S plus or whatever, like R. And I was like, hey, let's try creating, I sometimes build like simple toy versions first of things to see how they work before I tackle the actual, if you will. So I said, try building one, because we were debating what's the safety level, if you will, the probability level for an individual deal, and what does it roll up to, for the portfolio? Because this was the big debate, was like, oh, if we make it too strict, if you have too much capital allocated at the deal level, then, the prices are going to be uncompetitive versus, if it's too loose, we're not really doing anything safe or whatever it was. So that was real research in action. And again, I guess I felt, culturally within the profession, I knew intuitively that we were doing really valuable work, and I also knew maybe the leap that would help somebody want to try to, make somebody want to try to do this is to say, if it's important to me and my company, I'll bet it's important to others, right? In the profession, that it was nothing unique about the problems we were addressing at American Re. And it turned out in retrospect, that was true, because, we're tackling the same problems, every subsequent employer and every company I dealt with at Guy Carpenter. I got to tell you, it's just, I feel like these problems that I've been trying to tackle in some respects are, I'm proud of some of the progress, but I don't think all of them have been fixed. And I think the evidence is pervasive out in the industry. The amount of companies still struggling with this stuff, the amount of, and I'm trying to remember which presentation you saw, but I know I did one where I basically told I was telling the actuarial audiences, we're in like the perfect storm here, because people implementing a capital model, capital allocation is 100% actuarial expertise. It's too technical or somebody with really strong quant skills. It's super sensitive to expert judgment. There's plenty of different ways to do it that all have what other scientists would consider, enough kind of academic rigor and backing, that they're not just complete, arbitrary. So you got that's a perfect storm. It's like a lot of expert judgment, big impact on the business, right? Like the difference between let's write casualty or let's not write, this is not just, minor differences. It's like, okay, major impact on the business, a lot of data issues, a lot of expert judgment required, a lot of possible methods we could use, et cetera. How do we tackle this? And I thought I still do. I think it's a great call to arms for the profession, because there's certainly no competing professionals in insurance that have been able to kind of step in and fill it. But I still feel it's a largely underserved need. I think we got a lot of work still to do, because it's, this is a big deal. You do the pricing the right way, and the company gets stronger and the portfolio gets better, and you do it the wrong way and the company goes out of business. So, you can't ask for more business impact than that. You got the role you want, the business impact is there, but, we still got more homework to do, unfortunately. So,
I like this idea, and you kind of touched on it a little bit there, that there are certain problems that are just kind of in the air, right? That the industry collectively is working on or thinking about, or is frustrated to an extent that people are attacking them. I'm struck as well by the RMK algorithm, where how that was independently discovered by by two groups, by yourself and also Rodney Krebs, and that's obviously something that was just people were just working, and probably other people working on it too elsewhere, but they're just out there, right? And that idea is ready to get solved, and the business, the best minds, or at least the ones who are available and willing to give it a shot, crossed with the best ones, solve it. They solve it simultaneously. And isn't it interesting that that there was an unpublished manuscript, I think, of Krebs that you tracked down. It was nice of you to include him in that, because he didn't put it in any papers anywhere. How did you find that out?
That was through contacts at Guy Carpenter as well, like friends through the business. And I think Dave Room and I may have even seen Rodney present. Look, Rodney Krebs, is an incredible guy. And for people that don't know his background, he was a physics professor at
Toronto, wasn't it?
Princeton.
Oh, Princeton.
I thought it was Princeton. I know, for 17 years. So, and then at age 34, he left it all and went and became a carpenter for 17 years, right? And then at age 51, he walked into Fireman's Fund, where Bob Butzik was working, and said, I want to work as an actuary, and I like to ask people today, based on hiring criteria, for 51-year-old former physics professor who'd been working as a carpenter for 17 years, 6'8". Yeah, exactly. Would you hire this person? And almost everybody's like, hell no. And I'm like, well, that was, that guy transformed the business. So, you tell me, right?
Yeah.
He rewrote the rules. So, think twice before you sort of turn people away or whatever. But yeah, I mean, he and again, he and I and Dave, he and I were really good complement, and Dave Room's almost like, a hybrid of he and I. Dave Room's tremendous mathematical intellect, and again, I know my strengths and know my weaknesses. I'm not a mathematician. I'm just more of the explorer and engineer type. And Rodney, being the physicist, had almost the formal framework. But what Rodney was really great at, and in fact, one of the best things he ever did, was only done in a presentation, and it's really hard to find, but you can dig it up on the CIS site, is his presentation on presenting reserves and reserve ranges and reserve opinions. And in fact, even on reserve ranges, and being the great clear thinker that he was really like saying, well, what constitutes, the performance criteria for your reserve range? In other words, what does your customer want, right? And it introduces all these, and again, he's the only one that's ever put it out there, and he just put it out in a presentation only, not a paper that I know of. But this idea of like, do they want conservatism from you? In which case, in other words, you're almost looking at it like saying, are they going to punish you if you're low? Do they want the most optimistic? Do they want what do they want? And that determines sort of what range is best for what management wants. So that's just an example of how Rodney tackles this thing. And what became his riskiness leverage models, which I think, again, that was the formalized version of this RMK idea. It's right in the same. This is just more. If he just was filling out more of the framework about, what I mentioned earlier about this notion of moving from a function of the expected scenario to taking the expectation of the risk function, if you will. And he just formalized and said, look, in many ways, this is, and I ran into trouble, believe it or not, especially among the more academic and a lot of the European actuarial bodies, by being a proponent of utility theory. And it wasn't academically utility like economists and so on, because I know that they've had issues or whatever with how well does it work in practice. But at least this notion, utility theory, was at least an example of E of F of X, because it would say is like, here are outcomes, and utility was quantified quote unquote, feelings or perception. And what Rodney did was really kind of give legitimacy and mathematical legitimacy to saying, yeah, that's okay, right? And that's, in some ways this is weird, but this is what the evolution of a science in many ways, when you're talking about, breaking a paradigm down, you have to sometimes have the brave souls that will say, like, hey, it's okay for us to think about this alternative way of doing stuff, and by the way, we can still preserve rigor and whatnot. And I think it was in his riskiness leverage models where he really just, shone great light on, like, saying, look, folks, and I think maybe he even coined that when he was presenting on it. He's like, there's these riskiness leverage models and functions, you're already using them. Even if you don't think you are, if you're, using standard deviation of whatever for a risk load or so on, it's like, and once that came clear, I was like, wow, look at that. What it made clear to me was that the industry therefore had to do the work, to articulate this stuff, possibly, through trial and error and so on. And that's what's been happening since he wrote it. Again, the last 10 years has really been with this evolution of ERM and these capital models and the ORSA, is like this idea that, your own view of risk. I mean, that's been formalized. AM Best, ORSA, whatever. Everybody's saying it. Like, you got to have your own view of risk or whatever. That is, riskiness leverage models or utility or whatever you want to call it, risk preferences. The name is irrelevant. What matters is what he laid out there, what we had, David and I had hacked together kind of, for this notion of conditional probability. Just means look at the scenario, right? Again, you can sort of, you can see, David, how it all sort of evolved, right? You go back to the Center Re days and the risk load and the default rate of surplus. The idea was to go, okay, let's look at the scenario level and, let's see if we can quantify something in that regard, and then you move it forward. And that's what capital consumption was, an attempt to apply that to pricing reinsurance. And then, here's RMK, and then, culminates with putting it in the shared asset framework, which I really think is the, that one. I'm proudest of that accomplishment. I'm pleased that, at least the UK society has, basically the UK, the general insurance track and the UK actuarial society, the only treatment of capital allocation is mine. So I'm really happy with that. I understand the CAS takes a kind of a little slower approach on adoption or whatnot, but I feel it's the definitive framework. I think there's work to be done regarding quantification, but I feel it's actually finally a complete framework that encompasses everything we've been doing in one nice, neat package. So,
you said that's the capital consumption model. Is that the one you're referring to? Capital consumption.
No, insurance capital as a shared asset. So really, if you look at capital,
it's in the reinsurance paper too.
Precursor to that one,
I think. Yeah. That's right. I like that paper, and I like that idea. And let me see if I understand it. Speaking to the master. So the idea here is, instead of dividing up the pie, you actually are sharing the pie, and those do mean different things, because any one person could eat the whole pie. We just don't know who it's going to be. How is that for a metaphor?
That's it. Yeah.
And what are the downsides of doing it wrong? What happens if you divide up the pie? How does that think of it from like a market standpoint, efficient markets standpoint, where an idea is true only if those who don't adopt the idea fail, right? And so what is like the failure condition for people who don't adopt this capital allocation or capital consumption methodology?
Yeah, I don't think there's a general rule regarding saying, if you do one, you'll succeed versus the other, you will fail, et cetera. But where my thinking has really evolved, especially with the last 11 years with Carpenter and getting to see firsthand so many companies with taking their shot at kind of making this thing all work is, and also I'll bias my comments to the larger companies where it's about reducing operational friction. I think there are, so I'll give you the example. I built the shared asset framework again, because that's the way it works with me, based on me trying to roll out a capital framework within GE Insurance, which had life and P&C and had medical expense, health insurance that had like monthly payment patterns all the way out to, term life, with long and excess work comp with 50-year payment patterns. So the whole time-related aspect that was crippling us back at Century, it's like red alert. Plus you had life actuaries that were looking at like we're from outer space. So, an entire year of struggling with the life actuaries until the light bulb came on finally. And I said, oh boy, I understand now using the shared asset framework, that life is all about rental capital. And they called it, face capital, whatever. They used to talk about capital planning and whatever, that they could, plan it out for 20 or 30 years. And then, P&C folks would just be like, what we were like, what in the hell are you all talking about here? It was a real struggle. So, the simplicity of the shared asset approach is that finance people get it, because at its core, and remember, one of those other learnings I had is, look sideways because somebody else might have solved it. Insurance is much closer to lending than anything else. And in a lending environment, this is what companies are worried about. They're not worried about banks are not worried about allocated capital in the lending environment. They're worried about principal, right? And what are they worried about? Simultaneity, right? Like, what if bunches of our people default at the same time, right? What if borrowers default at the same time? So that when you get the finance people on board and you stop having to, try to explain confusion around allocation methods that are not additive, or that, inability to explain to them why there's an S&P framework that produces this number, but then our model produces this number. These were all problems I had. I literally had to come up with that answer because the CFO said, we're not having two capital models, right? And again, the actuarial approach was, he said, he goes, we just got our S&P rating. You have to use the S&P factors. And yet I had all my other constituents, right, which is all the pricing people and the underwriters, saying, we need risk-adjusted ROE, right? RAROC. We need RAROC. We need RAROC, right? So it's like if you have fixed capital factors handed to you from the outside, but you have to produce risk-adjusted returns, what do you do? And the answer is that. It's almost like that's my cut the knot idea or whatever. So I can't tell you, but I can tell you is during the 12 years that was published, that everyone I've shared this with is seeing the operational benefits. And the good news too, and in some ways it's a bit like stone soup, in that it's not that you're going to end up with different results, because the shared asset approach, all these approaches need to be calibrated to, target ROEs, what's our required capital approach, are we using, S&P or whatever, or Solvency II, Everybody's got to be calibrated. That doesn't really change anything, but it's more about transparency of what you're doing, which is supposed to be part of what they call the use test, if you've heard that term from Solvency II, yep. Right? That's this idea that you're supposed to eat your own cooking. Don't just build the capital model, right? Actually use it to make decisions.
Don't do it for me. Again, do it for you.
Right. So back to that problem with the perfect storm idea. The perfect storm problem of capital allocation to me is use test. You're not going to get to the use test if you have to use a lot of jargon, if you have to, if you give them numbers that don't add up, if you get order dependence, all these problems. So it's like, at least in that respect, the performance of the shared asset approach has been exemplary to me, and that it just clarifies what levers are available, and then says, look, you still have to make decisions, you still have to run your company, this is just a way to do it that hopefully makes those judgments clear and obvious to people, and then they can do sensitivity testing.
Yeah, I think that one of the things that I like to say, or way I like to think about what capital models, and capital models are one manifestation of what I think of as really what compute power developments have kind of given the insurance industry, and I think of, in some ways, your the whole intellectual side of your career as you just kind of figure out how the heck we use all these computers and storage, and how do we apply that technology to the problems of the insurance industry. And the answer is simulations, and the answer is measuring things more carefully and doing something with all that data. And one of the things that, of course, the main thing insurance companies do is they pool risk, and they make sure none of it kind of drains the whole pool. And you wrote some interesting things about the financial crisis and how you felt actually that the ERM worked in kind of a deep sense, and I interpret that as actually capital modeling made us as an industry more resilient. And
yeah.
I think that and I'd like to get your reaction to this idea, one of the ironic outcomes of that is it actually makes it harder to compete because insurance companies are more stable, and it creates fewer disruptions. And disruptions historically has been the window of opportunity through which the best players can jump through and the other ones cannot. But if everybody is on a pretty similar footing, doesn't that mean that the soft market genuinely will last longer than it would have 30 or 40 years ago?
Yeah, you nailed it. Yeah, and absolutely right. I mean, look at CAT. Right, property cat, Guy Carpenter and I'm sure Aon, whatever, have tracked, bid ask. It's an opaque market, but at least among their clients, they'll share. And I'm not speaking out of school because I think they publish on it as well. I mean the bid ask spread is just super narrow, and that's a function of two things. Number one, the vendor modeling, right, getting good enough that pretty much, maybe some people like a Renaissance Re are maintaining sort of they'll run the vendor models and they might have their own view of risk or whatever. But if like you said, if around the capital markets, whatever, that's the lesson we've learned. It's like, it doesn't matter if the model's right or wrong if everybody's using it, right? What are you going to do? I'm going to run my own CAP model and it's going to give me a number that's 20 when everyone else is centered on 10. Then your option is to take 10
or you're out of business.
Don't play.
Yeah.
Right. So feel free to run your own model, but it's only so
sit there on your couch and run your own model all day.
Right, exactly. But the vendor models plus the rating agents, probably the biggest change, and you've seen it with this last. I'm sure you'll see it with 2017 as well. When after 04, 05, when the rating agencies, AM Best in particular, said, look, maximum any one occurrence, right, in the stress test. It's like that just did more to limit unforeseen leverage, which really what leads to impairments and failures, right? It was like, look, so now you got it. It's like everybody's more or less using a small set of models. Everybody's more or less, about equally levered. Nobody has big informational advantages. It's easy to get into the business. Probably the bigger thing that's going to keep the market relatively soft, which I'm sure, we certainly we'll see the proof in the pudding over the next year or two, or I'm assuming, because prices are starting to go up, is how easy it is now to bring capital into the business, right? Whether it's through the securitized vehicles of existing players, something like AlphaCat from Validus, and there's several others like that, or an existing ILS fund like a Nephila. I mean, Nephila was the biggest catastrophe market, right? The biggest provider of reinsurance capacity for catastrophe, I believe, in the last couple of years. So, and that's all, that's pension fund money backed, if you will, and that's not hard to scale, right? That's not the old Swiss Re or Munich Re or whatever, from the 1980s or 90s where you had to, we want to write more business, we have to hire more underwriters, and It's like, look, they're, they can, and plus with analytics, right, then you're going to be like the hedge funds, right? You're going to have some senior underwriters, and you're going to, how long before we have machine learning doing a lot of the underwriting? Who knows? I don't know. I'm not trying to scare people or whatever, but yeah, I think those factors together, I think there's a lot of people and senior people in the industry saying, are we ever going to see the super hard markets again? Where you're right, that was where there was a lot of recoupment, if you will, right? It's almost like now it's like, prolonged periods of inadequate pricing, and it used to be followed by huge upsides, right? I mean, it was like the late 80s for casualty, after the 84, 85, 86 with the pollution and the asbestos, then there was just, massive profit taking for the next several years, then after 01, right, and so on, right, and 04, 05. But now it's like this one, it's like, well, what's the proposition if you don't get these giant upsides anymore? I don't know. So.
Well, there's a funny kind of, I don't know what you call it, a winner's curse. Like if you were to write sort of the manual for let's call it, the invisible hand were to write the manual for insurance, right, and say, what do we want it to do? What we want it to do is we want to provide stable pricing, a big pool of capital that is not going to go away, that manages its risk, and is a consistent source of capacity for the rest of the economy as a backstop, right? And that's what's happening. Yeah. And ERM, I think, and capital modeling, it was working in a really deep way, and so that's great, except that it's making it harder for individual practitioners to differentiate themselves and make money. It's causing a lot of consolidation in the industry, which is a natural sort of progression towards reduced expenses. You have to pay for all these Don Mangos to actually run the capital models for them, which you didn't have to do that 40, 50 years ago. And so I'm wondering if there's kind of like a dark side to this whole thing, a different dark side, which comes to innovation. And if you have these large organizations which are classically more have a harder time innovating, and smaller companies are better at innovating. And the smaller companies are going away because they can't afford the fixed costs, and they can't afford it's hard to burn your way into the marketplace because the incumbents are so powerful and they have so much business and so many deep relationships, and they're not going away. And so, where does the innovation come from? Is it because of this? Are the actuaries the only hope for us and our conferences and our papers where we're actually going to do stuff together, or the big company is going to be okay?
Wow. I think you're seeing the model. So we got to go to a fintech because the banks are in the same boat, Like you could say the same argument, I think, for the banking that you could with insurance and reinsurance. They're all heavily capitalized. They all consolidated, maybe at gunpoint in 08 and 09, but they're big. They're probably, most of them are too big to fail at this point, et cetera. But we went to a conference at NYU where they had some NYU professors saying, the regulators should get out of the way. They should let the startup ecosystem evolve, in an unconstrained manner, and that the startups are going to come in and clean the clocks of the incumbents, et cetera. And then there was a guy from BlackRock, and he gets up and goes, that's all well and good, but you have to remember two things. Everybody in a startup wants a buyout, and the people with the money are the incumbents. So I think you're already seeing is that what's good is that the startup environment is very attractive to a lot of talented people, really smart people, no knowledge of insurance, which is a good thing. So they don't know what they don't know. They don't know what's been tried and dismissed in the past. We have a lot of history in this business, a lot of inertia. It's a complicated system. It's highly regulated. It's not going to be displaced, right? It's going to evolve, and it's not going to be a revolution. It's going to be an evolution. But what we're seeing already is stuff gets interesting and attractive enough, and then a big incumbent scoops it up. So what the incumbents are, a lot of what we're seeing is what the incumbents are doing in that space is they're trying to be the ones with the controlling investment in the promising technology, early enough in its life that it can be, brought in on a proprietary or favored terms manner, as opposed to just the wait and see. I mean, you can just wait and see, let it all evolve, and then some big, stuff's going to look. There's not going to be 20 drone companies. There's not going to be 20 machine learning platforms, et cetera, right? A lot of this stuff right now, it's just high flux, high uncertainty, really, really fascinating and interesting time. But you're gonna start seeing just a necessity, of We're going to have some IoT data standards. Okay. We're going to have some connected home or smart home sort of, some major players through whatever they buy each other, or somebody starts buying them, or I don't know who. I mean, there's all sorts of companies positioning, the home security firms or the cable companies or whoever. There's lots of people with money in an incumbent role, that are concerned enough, and stuff's going to kind of get bought up or whatever. But so I think insurance will, like we said, I think there's three waves of insurtech. The first was stuff that was new to insurance, but not new to the tech world and the digital world, and that was the easier stuff around. Let's say, hey, you should use Facebook to do personalized ads for personal insurance, and be on a mobile platform. And oh wow, the insurance industry is like, wow, that's incredible. But it's like, yeah, well, they've been. That's old school by Silicon Valley standards, which means it was 3 or 4 years old or whatever, right? So that part's already kind of happening. It's primarily personal insurance, but it's a lot in health, a lot in life too. It's it's cross P&C life health, it's not anything specific to P&C. Second wave is kind of happening now more. That is heavily operationally focused. The insurance industry is probably employs too many people, right? Well, I'm being generous. We employ too many people. Okay, there's too much paper processing still. There's too inefficient. I think it's a unique business. Again, having been exposed to a lot of these startup types who just can't wrap their heads around our business, I like to say, look, this isn't Samsung. Okay, which can, if they want to, they can shut down the Galaxy assembly line tomorrow and do anything they want to change anything they want and then restart it, okay, whenever they want, and they start making new Galaxies in any different new way they want. Okay, we can't shut down the assembly line. Okay, if you're an insurer that's been in business a while, you got policyholders to deal with, you got data coming in, so let's say take IT, if you want to evolve IT, quote unquote, in our business, it needs to be fully backward compatible. A lot of companies have, a lot of legacy systems and so on. It just means we're highly constrained naturally. You can't just go in and say, we're going to completely do, everything differently now with our customers. Where it's like, yeah, that's great, but you have to be able to still service all your existing customers, with no disruption, right? There's like zero risk tolerance here. It's like no disruption. So, it's like it's going to be not that innovative, if you will. It's going to be slow there. But things like robotic process automation or blockchain, or something along those lines, a distributed ledger or something, this and the banks, some of this we're going to be following the banks. They're moving to mobile bank, mobile payments, mobile enabled identity verification, digital video processing. You're already seeing that with Lemonade and some others, Metro Mile, I think, it's one of these new auto companies. You can take pictures of your car, your accident, you take pictures of your car, send it in, and, they can use machine learning to quote unquote validate it, and then boom, that's radical. Okay. And then again, that's radical to everybody, but really to insurance. So that one's going to benefit the insureds, and the stuff's going to work better, and it's going to be cheaper. So that's all good. That's going to be painful though. That's going to require investment, and that's going to separate the winners and losers, because the expense ratio, your point before about kind of how level the playing field is on the sort of pricing front, the expense front is, anybody's ball game. And if somebody figures out how to, go digital and automated and whatnot, and they can drop every point they drop their expense ratio is either, a point more profit or a point price drop they can take, to win more business, et cetera. I mean, that's a big deal. So that's the battlefield now, I think probably next several years. But I think the big one that's looming out there that's going to really, really do some damage or really force change was when IoT and connected and whatever. And that's what I've been speaking on in the Actuarial Society about actuarial engineering, this idea that's preventive analytics. never mind predictive. We like to talk about predictive analytics. I'll take prevention, over prediction 100 out of 100 times, because, it just stops happening, right? Never mind, you can tell me which workers are more or less likely to get injured. I'll take they wear
Stop them all from
sensors
getting injured.
Yeah, exactly. Yeah, I know exactly what my workers are doing, and they have sensors on their heads and et cetera, and their vests and whatnot, and I have black boxes on all my commercial trucks and all my tractors and backhoes and blah blah blah. It's like, you tell me. It's just that one that's going to change who bears the risk, who finances it, the role of an insurance company. I don't know, and unfortunately, or either fortunately or unfortunately, if you see the news on telematics and self-driving vehicles, whatever, it looks like it's going to be here a lot sooner. There was all these predictions. Oh, it's going to take 10, 15, whatever years to work its way in. It's like, well, actually, it might be here, in the next few years.
Yeah, it'd be 10 years of being done, followed by an overnight success.
Right, exactly. Yeah. So anyway, I don't know if I answered your question specifically or whatever. I think it's a big opportunity for actuaries, but we're going to have to be prepared that we may not be employed by insurance companies. And I think there's need to adapt the educational process to leverage that, but that's going to be tricky, because there's a lot of the education that's really tied to servicing an insurer. And if in 3 years' time or 5 years' time, Toyota is insuring Toyotas, if you will, or because Tesla's already said, yeah, we're doing it, right? And I don't know if it's 3 or 5 or 7 years, whatever, but at that point, if you're saying, hey, would you like to hire a trained professional that knows how to fill out a yellow book, regulatory forms, and how to do statutory accounting, and how to do, reserves for yada yada, they're like, no, I need a quantitative risk professional. It's kind of like they need the actuarial core, but are they going to be willing to pay for all of the extra education that was, that's frankly, servicing a model that, again, I don't know. In 5 or 10 years, are there going to be 20 gigantic insurers? Will there be smaller ones? Whatever. I don't know what the landscape's going to look like, but again, I think there's an opportunity for actuaries, but I don't think we can just sit back. I think we're going to have to justify our value, which I think is strong, but we're going to have to be, learn how to justify it and how to stretch ourselves into other areas.
Gosh, Don, I feel like I could talk to you for hours about this stuff. But we should probably call it a day pretty soon.
Yeah.
I did want to get you an opportunity to talk a bit about what you're doing right now, Insure Solutions, and sort of what you have on your horizon. What's next for you?
Yeah, it's really a focused consultancy around the expertise I've amassed through my career, and then specifically InsurTech and innovation advice. So I'm advising either as a board advisor or whatever you might call more of a strategic advisor, product development advisor for several InsurTech companies or accelerators. All of them, and I think this is a great opportunity. There's a lot of what I provide to them, many actuaries could provide, or many, senior underwriters, whatever. I think I've written about this some. There's great hunger from these innovative people to learn about our business. It's an incredibly intimidating business, and we that have been immersed in it for as long as certainly I have, or whatever, you've been in it 10, 20, 30 years, whatever, you take for granted about, all the machinations and the way the strangeness of the way it all operates. Most people's experience of insurance is whatever, State Farm, or it's like, I buy insurance from whoever, boom, that's it. It's very simple. And some of that's why they kind of come in with this notion of like, this should be easy to change, whatever. And so again, I don't feel the advice I provide for the most part is relatively easy for me to provide in terms of it's not taxing me to think like, right. It's more, recounting, right, recounting painful lessons or just sharing with them. Well, gee, let me explain what an agent is, or let me explain just because they're interested. We're a very attractive target for these folks, right? Because there's a lot of money in insurance and it's not going anywhere. It's very stable. So, it's no wonder that they see us as an attractive thing. So that's my main focus there. I also teach a course with a guy named Jim Marr, who's Chief Risk Officer of REN US. He's another FCAS. We teach a course on risk management in P&C insurance at Columbia's actuarial program. We felt that, there was a need for a practically oriented P&C course to help the actuaries there. Probably other actuarial programs could benefit from something similar. We've had great response from the students. They're very interested in P&C, and generally speaking, most of the, at least U.S., and I hope maybe Canada is different, most of the U.S. university programs are not as deep in P&C as we would like. So they tend to get a lot more sort of life, health, pension, and so we're trying to kind of fill a void in that regard.
I think that's a very good idea. I did a mentorship program with Columbia one semester, and I think it was a great experience for me and a great experience for the students. I think it's a great thing to be able to get them a bit farther along down the track, having hired actuaries myself, as much as you can. So I'll wrap it up there. My guest today is Don Mango. Don, thank you very much for joining me today.
No, real pleasure. Thank you so much.